This is a follow-on video. We'll be discussing valuation. In the last video we discussed inputs into the Polaris model for determining theoretical valuation. This short video is on how we end up with a practical valuation from a theoretical, because again, here I am on the website, I'm looking at Microsoft. As I move the input of sales growth around, I'm really moving the theoretical sales growth, which you can see clearly here. I'm at 20%. I move it up to 33%. So I am moving specifically the slider value as it pertains to the theoretical value. So the question is, what is the practical value? And since that is the one that eventually is used by investment plans. In fact, if you look at some investment plans that I have, the target return is the practical investment return, which is based on the practical value that the Polaris website calculates for you. So the question is, how does the practical valuation get created from the theoretical valuation? So that's what we're going to be briefly discussing. Here's a busy looking chart. I won't be going through much of it, just some general overview. Before I get into that, I do like to reference a quote from John Maynard Keynes. He is a famous economist that lived from 1883 to 1946. He published the book General Theory of Employment, Interest, and Money in 1936. In chapter 12 of that book, titled State of Long-Term Expectations, he wrote, "Valuation should account for current market realities." Now, that's not the exact quote, but I'm paraphrasing. And what he's implying is it doesn't make sense for someone to create a valuation no matter how confident they are in the model and the inputs to the model, if the valuation that it calculates is drastically different than the market. That would borderline on arrogance to think that you're able to ascertain a intrinsic value that is significantly different than the overall market, in thinking that the market is wrong, the valuation is correct. At some point there needs to be some humbling of your valuation with the current market price. Now, to go all the way and say, well, we'll just make it equal to the market price, then it defeats the whole purpose of valuation. But there should always be some account for the current market price as it relates to the valuation. So the way the Polaris does that is that here in this chart, looking at Microsoft, and roughly the price that Microsoft is currently trading at, it can be mapped into the chart at this price point of about $111.08. Now, the way it got mapped into this chart is it's based on, for those who might know a little bit more about the financial theory of capital asset pricing model, but the risk of the stock, which is represented by beta, and the growth estimate of sales. Well, the same formula that's used for calculating a valuation is reverse engineered based on the current price, and it says, well, for the price to be what it is, the market collectively perceives a certain level of risk, which in this chart is represented by 1.2, and they have a growth assessment of about 30%. A theoretical valuation is $71.67 in this chart. And so you got quite a big discrepancy of almost $40 a share. The market is currently pricing at around 111. Well, you could just, like I said, have extreme confidence in your valuation and just sit tight, saying that until the price comes down, Microsoft is extremely overpriced. But then you might be wrong forever. It may never come down. It may continue to go up from here. So Polaris attempts to make a more inclusive calculation called practical valuation that attempts to incorporate what John Maynard Keynes suggested about not being fully blind to the current price, but to try to take some reasonable account for the current price in your valuation. So the way Polaris goes about doing that is it says, well, how much tolerance, how much wiggle room do we feel that the market at any given time might have in terms of the current price? Yes, there's always going to be those black swan events where you could see a major macro event or a event specific to the company, like a lawsuit, that would cause the stock to overnight go down dramatically or go up dramatically. But outside of that, on a more of just a normal expectation of how much price could vary, Polaris assumes that the market will be willing to change its opinion about risk somewhat. And that's what's represented by these shaded areas, is around the current price. Polaris is saying, as it relates to the current valuation, that the current valuation is kind of a draw. It's kind of like gravity. It's pulling that price towards the valuation. So as it gets pulled, how much would the market, we feel, would be willing to be pulled towards that valuation? Well, in this chart, it's saying that we feel that the market would be willing to be pulled $111. We could see with some change in growth expectations by the market
and change in risk assessment,
that this price could get all the way down to around $79, $80. So practical valuation is trying to build in how much wiggle room can we really expect from the market in a reasonable time frame, and based on that wiggle room of growth reassessment and risk reassessment, feel like the best case would be maybe get it down around $80 or $79.79. That becomes the practical valuation. Now, once you have a practical valuation,
which in this graph
is shown in the orange line, is the practical valuation. Here today it's about $79.79, and then we assume the same increase in price that we did for the theoretical valuation, which is the blue line. So you end up with a parallel line, the orange line, to which is the practical, to the theoretical. And so now the ending price point in 5 years is not down here on the theoretical line. It's now moved up as you try to account for the price is what it is in terms of almost $80 today. Where will that likely go, even considering what the likely tolerance is or wiggle that we could expect from the marketplace in terms of how much higher we could justify a valuation being, as we are taking price into account. So even with Microsoft, even if we take into account the current price of 110, we can only get to about $80 today, and then eventually 5 years from now by around $120. So if price is going to change from 110 to 120, that's not a whole lot of appreciation. In fact, you can see here that the investment return is being forecast to be very negligible for Microsoft. So anyway, that's a brief explanation of concept behind practical valuation. Thanks.